Beware dangerous dividends. What? Dangerous dividends? I'm going to share with you. This is a fantastic article that this guy, I'm not familiar with this guy, Andrew, what's his name here? Aaron Brask, Dateline 12/21, was actually first published in 2015, which is kind of weird. Destroying steady income streams. And we're not going to read, there's a good long article. We're not going to read the whole thing. But the premise was that dividend histories of high quality stocks only had a 5% drop in 2009 and a 2% drop in 2013. Whereas the broad market had a 23% drop in 2009, the financial sector primarily. And then large company stocks, mostly financials, had a 50% drop in 2019 or 2009, excuse me. So that's a concern. And so his question is, his thesis, how do you avoid this? And we'll go into this a little bit. And he kind of talks about how even some of the largest funds out there, American Capital Income Builder, Templeton Growth, T. Rowe Price Equity Income Fund, had significant drops, as you can see here, in dividends in 2009. All right. Now, his premise is, if you're relying on dividends to live on, you had a hard time dealing with that income reduction, that's for sure. So let's keep going down. So now but then he says, so bonds aren't going to give you the salvation. He talks about bonds. You can see the drop here from 2009 to 2015 of income. And again, the drop here from 2007 to 2015. And then here, the Loomis Sales. So we got the Dodge and Cox Income Fund, one of the best funds out there for the income producer. Significant drop. We got the Loomis Sales Bond Fund, another good one, and the Templeton Global Bond Fund, not quite as just distinct, but still up and down, up and down. And the bonds didn't give you a reprieve either. And the reason for that is because the interest rates are dropping. So interest rates drop, your income drops. We have market decline. You can see here, your income drops. So that's bad across the board. So what his response would be is you should buy high quality dividend stocks, which we'll share with you here in just a second. And he uses these 6: Coke, J&J, Johnson & Johnson, Procter & Gamble, CVS, Walmart, and IBM. And we looked at all these, and they have all continued to grow since 2015. Now we're in 2021, and all of them did. A couple even grew. I think CVS, Johnson & Johnson, IBM, I think even grew by more than 33% since then, which is significant, man. So he's saying these are high-quality stocks that have grown, increasing dividends each and every year. So not only did you not lose dividend income, but you actually gained as well, even during 2009 carnage. So that's pretty interesting. Now you notice that CVS, Procter & Gamble, Johnson & Johnson, Walmart all kind of fit in one category, Coke and IBM another, but still consumer staples for the most part, right? All right, but however, where are you going, Pablo? Listen, I want to talk about unintended consequences. Let's see. All right, so unintended consequences of investment mandates. I'm going to call them strategies. So the dividend yield strategies naturally focus on companies with, right here. Dividends are primarily based on one of two dividend strategies. The first and most popular strategy focuses on dividend yield. The second strategy focuses on companies who have histories of growing their dividends. All right, so this right here would be growing dividends. That's the second strategy. But the most primary strategy is dividend yield. And I hear that all the time. What do you think about this? Has a high yield. Unfortunately, neither of these dividend-based strategies is geared towards achieving a stable income stream. I'd actually say a stable return on your portfolio. The dividend yield strategy naturally focuses on companies with higher dividend yields. This approach is generally viewed as naive. Indeed, high dividend yields indicate low valuations. They indicate, I keep looking for Finney out there, they indicate low valuations and often indicate distress. This is especially true when the yields are extremely high relative to the peers. For example, consider a company that paid dividends over the last year, but more recently ran into significant issues. Come on. Bank stocks during the credit crisis comes to mind. The share price generally falls due to the bad news, and accordingly, the reported trailing dividend yield will be higher, but indicative of the distress. All right, so basically they're saying the trailing 12 months at a $2 dividend is trading at $10 a share. That's a 20% yield, if that makes sense. Well, if it's trading at $50 a share and it had when it had a $2 dividend, that's a 4% yield. Does that make sense? So on a dividend, you understand. So again, this is where I was having an issue with the price to earnings ratios being so low at the beginning of when we first had through this pandemic thing. We had the price is today. The earnings and the dividend yield is based on the previous 12 months, the trailing 12 months. But the price is today. So the earnings or dividends are hindsight. The price is current. And that, when you're using those two numbers, you can be very mistaken in terms of, whoa, this dividend yield is high. Well, yeah, it's high because the price has dropped and the dividend probably hasn't followed suit yet. Or in that case, the PE ratio is low, well, because the price has dropped and the earnings probably hasn't followed suit yet. I hope that makes sense. So anyway, that's a trailing 12 months. That makes sense. If there is no distress and companies continue to pay and perhaps increase their dividends, then the dividend stream of high dividend yield portfolios would monotonously increase, would continue to increase without pause, if that makes sense. Monotonically. I don't even know how to say that word. However, this is not the case. Using the high dividend, the Vanguard High Dividend Yield ETF as an example. This ETF paid an annual dividend of $1.56 going to the credit crisis. But many of those dividends were cut, resulting in an annual dividend of $1.08 just 18 months later, representing a cut of 30%. So if you bought the high dividend yield Vanguard ETF, you were thinking, I'm getting high dividend yields. Until you weren't. For comparison, the dividends of the broad market were cut by 23% over the same time. In other words, the quest for higher yields ultimately led to a more volatile income stream. Due to the correlation between high dividend yields and distress of the stocks. I completely agree. That's the high yield always tells me it's high yield because the stock price is low, which is why value stocks outperform. The reason stock price is low is simple. It means it's something going wrong with the numbers, and that means it has more upside, but also could go kaput too. The second class of dividend ETFs typically identifies and invests in companies with sufficiently long history of growing dividends. So just kind of going back here. So this looks good, right? It looks good. Well, there's a missing point of this, all right? So as I discussed, this is a great recipe for identifying higher quality companies. However, these indices do not pay attention to the price paid to purchase these higher quality companies. They may replace or rebalance existing holdings with companies paying lower dividend yields. They can have significantly negative impact on the dividend stream. So consider Coke in the late 90s. Naive strategies focus only on the strong histories of dividends and the increasing dividends. Again, going back, going back here, you only focus on the increasing dividends. They're thinking it's a high quality stock. However, Coke bizarrely got caught up in the tech bubble and was trading at sky high valuations with a PE ratio over 50. So the yield was just 0.67% back then because the price was so high. And yes, it was increasing its dividends. Well, who cares? The PE was over 50. For comparison, 3M, the dividend yield was almost 4 times higher than Coke at the time. Investing in 3M instead of Coke resulted in significantly more income and capital appreciation. The lesson from these dividend-based strategies is that quality and dividend yield should be both considered if one wishes to construct a portfolio with more reliable income streams. More generally, this is just another symptom of a larger problem whereby the investment industry manufactures flavors to suit all tastes. I completely agree. They manufacture products based on a wide variety of individual factors and ignore the significant benefits achieved by sensibly combining multiple factors. Marketing trumps quality as the industry caters to advisors and their sales pitches instead of investors and performance. I could not agree more. So I want to pause. I want to look at, hold on just a second. Look at the Vanguard Dividend Growth Fund, which I own, VDIGX. And let's look back in time to see what the dividends track record were. Was it continue to grow? Again, I own this, so just disclosure alert. Part 2 of this, I still love Yahoo because they're the only one who gives a dividend track record going back. Morningstar doesn't, MarketWatch doesn't, even Charles Schwab doesn't, Vanguard doesn't either. It's crazy. All right, so what we're going to do is we're going to look at, we want historical data. Actually, let's take a look at this summary here real quick. Does it give us a PE ratio on this fund? You can hear Finn out there. Let me pause real quick. So here's a PE ratio of the Dividend Growth Fund, about 29.59, which is a little bit higher than the category average. But that's not nosebleeder in this day and age, that's for sure. My dogs are nuts. Love them, though. Anyways, that's high, but it's not certainly not nosebleeder. So let's look at the historical data of watching their dividends. And we're going to go to prices. We're going to go to dividends only. And we're going to go to monthly. And we're going to hit, we're going to go, let's go to, oops. I'll say 2000. And let's see what was hit apply. All right, so we got, and December is always a bigger one. So December was 22, all right, 20, 20, 20, 20. That looks good. 17 in June 2016. 2000. Okay, so they've been going up, going up, going up. Yep, 1840 in June 2000. So you can see June 2013, 18 cents. June 2014, 20 cents. June 2015, 20 cents, a little bit more. June 2016, 18 cents. June 2018, 20 cents. June 2019, 20, almost 21 cents. June 2020, 22. So that's good. So let's just keep going back. June 2020, 11 cents. Hey, come here. June 2002, 11 cents. June 2005, 12 cents. 9 cents. All right, so we got 2005. What do we say? Come here. 12 cents. June 2007. I don't know. Did they not pay dividends here? I'm not sure. June 2007, 14 cents. June 2008, 14 cents. June 2009, 14 cents. June 2010, 13 cents. A little bit drop, not much. 15 cents. 17 cents. So you can see that's what you want to see, man. You want to see just a growing dividend perspective, which this guy's doing. So let's go to V. What did he say? What was the fund he was using? Hold on a sec. So now I want to look at the Windsor Fund. The Vanguard High Dividend ETF, it only goes back to like 2013 or so. So that's not what I want to see. I want to see something that goes back longer. I'm not sure what, I don't know if there's like an index fund I couldn't find it. So I didn't look that hard. But I was looking at Vanguard High Dividend ETF that he was looking at. And the one I came up with didn't go back as far as his did. So I'm not sure what I'm missing there. But anyway, the Windsor Fund is notorious for being a long-time Vanguard fund. A guy named Neff ran it for many, many moons. Large cap value fund. So let's go back to go back to June. 13 cents, 2000, 11 cents in 2001, 8 cents in 2002. It looks like they only paid dividends twice a year. 8 cents in 2003, cents in 2003, 11 cents in 2004, 13 cents in 2005, 13 cents in 2006, 15 cents in 2007, 15 cents in 2008, 10 cents in 2009. Yeah, look at that. Ooh, 7 cents in 2010. Yikes. That's if you're living off 15 cents a share in 2007, you had half that in 2009 and 2010. Man, look at that. That's straight up ugly, dudes. That is straight up ugly. 2011 are back up to 11 cents a share. No, 2011 are back up to, no, it's still 9 cents a share. 2012 back up to 12. 2013 back down to 7. 2000, and doesn't look like the December dividend is making up the difference. 2014 back to 14 and a half, but 2015, 2008 is at 15. 2014 is at 14. Finally, 2015, 70 years later, got back above 15, man. Let's see what it's doing in December 2015, 16.5, 16 cents a share. Let's see, December 2008 was 12 cents a share. December 2009, 11 cents a share. December 2010, yeah, it just got smoked. Look at that. Look at that. Had one big year in December 2012, and then what's it doing now? Now it's at 18 cents a share. It's only 3 cents a share higher than it was 12 years ago, 13 years ago. 21 cents a share, December 2020. That's crazy, man. So the December ones have jumped quite a bit. That's good, but the June one's not. And Windsor's a good fund. I mean, this is not a fund that has high, I wouldn't think, has high PE ratio or anything. But just give an example. Let's see what we got here. I think we got to go to holdings, actually. Let's take a look. Holdings. Yeah, so they got a lower PE ratio. That's nuts. The point being, you can't just buy dividends based on PE ratio. About a yield. That's nuts. Don't do that. You got to buy it based on. Dividend growth. I just like it. They got a track record of increasing dividends for sure. And Windsor Fund is a little bit off simply because it doesn't. It's not. Its primary reason to exist isn't to increase dividends. So I was just using that as an example, though. But at the end of the day, what's his name? Aaron already showed us some cases that if you bought a high dividend yield stock, Coke in 2000, you're hating life, man. No other way around that. Actually, let's see what Coke did real quick. We're going to go to Coke. Let's see what it did in 2000, like what the dividends were. Let's take a gander. We're going to gander historical data, dividends. Let's take a look. We're going to gander. All right. There we go. And we're going to go to 2000. Right. There we go. So let's take a look. Oh. 2000. I get it? Yeah, okay, there we go. Sweet. All right, so we got here. So they're paying 41 cents a share, 41 cents a share in March, November. So that's, it was $1.64. But just we'll use this for simplicity. Let's go back to 2000. They paid 8 cents a share. All right, so they're paying 41 cents a share in 2000. They're paying 41 cents a share now. They're paying 8 cents a share back then. So we more than quadrupled our dividend payouts. All right, and if we're reinvesting those, we're also quadrupling our dividend payouts while we're getting more shares. So 8 cents, 9, 10, 2003, 11, 12, 14, 2006, 15, 2007, 17, 2008, 19, 2020. 20, there you go. 2000, yeah, look, increasing, yeah, increasing. 2000, 30, 33. And Warren Buffett owns Coke, but he doesn't like dividends. Well, he likes it with Coke, that's for sure. There's a lot of shares in Coke. All right, so now let's look at the price history, though. Isn't that interesting? So we're going to look at, chart is what I want. Let's look at chart here. Let's go back max. So while the dividends were growing up, respectively, what was the price doing? Oops, I hate when I do that. Yeah, come on, let's keep on going back. Keep on going back, Joshy. Keep on going back. Yeah, Josh. All right, so we got, it only goes back to 2000. There you go. So see a price decline there. Oh, man, I keep doing that. Man, well, you can see it went from, what's that? 28 down to freaking 18, up to 25, down to 20, up to 31, down to, I can't tell what that is, 20, up to 28, down to, you can see this, it's just rock and rolling, man. And then we've had this run, and then we had a significant drop off right here. So it was trading at 59 and fell down to 38. That's funny, man. Well, you can see, but the dividend kept kicking. So as long as you didn't sell, who cared, man? That's the thing. I know you got your butt kicked on the price, but as long as you didn't sell, who cared? PE ratio is $28. You know what I'm saying? It's paying dividends 3.27, trading at qualified dividend rates. I got no qualm with Coke. I think it's the crap they're peddling. I can't stand. Sugary drinks, but from an investment perspective, you have to make that decision on your own. Anyway, just be careful of dangerous dividends. I'm telling you right now, you do not want to get stuck holding a wet bag. All right, love to hear your thoughts. Thanks now.